Well, hello, brothers and sisters. This is Brother Lewis. I'll do a full review of Chapter 4 today. Before I started doing that, just wanted to make sure that you were aware of some of the information. So let me share my screen. Forgot about that. Wrong one. Let's share that one. Okay, we're looking at reporting and analyzing merchandising operations this week. Just double checking that everybody understands the name of the game for this week. Really, it's just focused on Chapter 4, right? So you have your Smart Book assignments, your quizzes at the end of the middle of the week, and then your quiz access and quiz and financial statement analysis at the end. Remember, you also have presentations. This is a recap of what I provided yesterday. But associated with Chapter 4 on analyzing and reporting and analyzing merchandising operations. This really is the first part of another part, which gets further deeper into the inventory process. But at least at the cursory level, you get a feel for how companies buy inventory and sell that to a customer, and the different types of transactions that happen there, and then how to do a couple of analyses in addition to that. So let's go through it. Why don't we see what we got? Okay, so a merchandiser is a little bit different, right, than a service company. And this shows you that for the most part, service companies, they have revenues that are mainly based on a labor base, right? So you have some laborers, usually have some what are called other direct costs. Those might be travel expenses associated with a project. It may be, copying supplies for books or pamphlets or anything that they produce for their clients go in here and they generate revenue. They subtract out their expenses and you got a net income. But on a merchandiser, you have to deal with a cost of goods sold. And that's usually because when you first buy it, it goes in as an asset. Okay, let's build out our income on our balance sheet here just a little bit. Okay, so on our asset side, and let's go liabilities side, and we're going to do equity. And we're going to do our little equation, equals and a plus. All right. So on, in addition to cash, and let's say accounts receivable, you're also going to have this thing called inventory. Okay, inventory. So when they first buy something, usually it's going to be, I'm going to set up a journal entry here real quick. So an account, a debit, and a credit. So let's say I want to purchase goods for sale. I'm just going to make that generic. So usually, oops, I don't want to underline. So usually what you'll end up having is something like, let's make this a little bigger. You'll have your debit go to inventory and your credit is going to go to accounts payable because you're paying for it on credit almost always. And so let's say I bought $100 in inventory, then it's going to go to $100 in credit. So that's where we get this first component of the merchandiser, right? They have to buy something. And then they sell it. Okay. So sold, let's say, let's go back here, inventory. Let's say we've got 100 units at $1. Okay. So let's say they sold it then, let's say they sold 10 units for $3. Okay. So when they sell it, they're going to get, let's move this down, cut, paste. So they're going to get some cash. Let's just take it directly to cash instead of to accounts receivable. and they're going to get some revenue, right? So let's say merchandise revenue, okay? And when they do that, they're going to get $300. No, they're going to get $30, right? So equals 3 times 10, and they're going to get revenue. And we'll just make it the same as that. So that's what that cell is going to be like. But the problem is that you have to take some of this inventory and move it, because right now it's on the balance sheet side, right? These are all balance sheet accounts. Well, balance sheet accounts. It's not really BS, but you know, it is BS. Balance sheet accounts, balance sheet. And then this is an income statement, an IS account, right? So now my income statement just shows merchandise revenue. It doesn't show any cost associated with it. And so what I usually have to do then is I have to have another journal entry that is going to move something from the balance sheet and put it into the income statement for the cost associated with that revenue. And so what you do is you allocate, let's see, transfer inventory to COGS, cost of goods sold, okay? And so what I'll end up doing is I'm going to move, and this is transfer, let's do, and this is just a simple exercise, okay? So I'm not making this very complicated. Transfer 10 units at, and since I bought it for $1, I'm gonna transfer it for $1. Dollar inventory to COGS. Okay, now when I do that, I'm going to credit my cost of goods sold. Now, when I usually write it in shorthand, it's going to be COGS, COGS. And that's going to be for $10, right? So let's do that in full. 10 units times $1. And I'm going to pull it from this inventory account. So pulling it, so I'm reducing inventory. I'm going to credit inventory for $10. Okay, so this is inventory. So now what I've done is I've got my income statement showing $10 worth of expenses, and I've got my balance sheet showing $10 less in inventory, right? So if I do a T account, I'd have $100 as a debit in inventory and $10 as a credit. So my net amount in inventory at this moment would be $90, okay? So you're just shifting things around a little bit. Now, when you look at this equation, right? So now I've dealt with my net sales. I dealt with my cost of goods sold. This effectively, your net sales minus your cost of goods sold is your gross profit. Sometimes people call this gross margin, right? They say this gross margin right here. You'll hear those terms interchangeably. For some companies, gross profit and gross margin mean something different, but in this case, we'll just consider them the same. And then you have other expenses, and these expenses would be something like rent, automobile expenses, selling expenses, general and administrative expenses, any operating overhead or general and administrative expenses would go here. And then you have your net income, okay? So most of this chapter is going to deal with this component of the equation, because really these are the same, right? Expenses and net income. But the question is, where do what intermediate steps you have to take before you start computing, reducing it by expenses to get to net income. All right, so this is a view of that. This is a service company. And by the way, this is overly simplified. I don't want to complicate things, but usually service companies also track some form of a cost of goods sold to get a gross margin, but in a very simplistic manner. They don't inventory their labor. They expense it directly once it's as it's earned or as is incurred. And so you'll generally be able to summarize a service company's income statement by revenue minus expenses equals net income. Whereas a merchandising company, you're going to have this whole cost of goods sold component, come up with a gross profit minus, minus your expenses to come up with a net income. Okay. So inventory ends up being a very, very important part of a merchandiser's accounting cycle, right? So this is the cycle. The question is, where does it start? Usually it starts with cash, right? And I showed that before. Cash made a purchase. That purchase turned into inventory. The inventory turned in some form of credit sales. I use cash sales, that's fine. So let's go back to our example. Let's say sold $10 units for $10 on account. We'll just say that. Okay. And we'll do the same thing, purchase goods on account. So now you see this one has accounts payable. This one, instead of cash, we're going to show this as accounts receivable. Still an asset, still a balance sheet account, but it's going to that place, right? And by the way, just to follow through with this entry, now we're going to have that client pay off their account, right? So we're going to end up doing on balance sheet accounts, we're going to do customer pays account in full. Okay. So that would all go to cash, right? And we're going to reduce accounts receivable. So in this case, they had $30 in accounts receivable. We're going to get $30 in cash and $30 in accounts receivable. This can get a little bit more complicated if you have a discount involved, which we'll talk about a little bit later. But for this part of it, then you get this cycle right here, right? So we've got the purchase, we've got it in inventory, we sold it, it became accounts receivable, and then we collected the cash. Okay. So theoretically, you know, if we were all done with this whole transaction cycle, we sold all these units, we should have $300 in cash at the beginning, whereas we probably we didn't show this as a payment on accounts payable yet, but we probably, let's say, only had $100. Let's say I started out with $100 in cash. We bought a bunch of inventory. We then sold it. When we're all done, we should have $200 worth of margin that we can then pay labor and we can pay other things. All right. Maybe the phone bill, stuff like that. All right. So this is a very important part of what you'll need to know. This will be tested over and over and over. Beginning inventory plus your purchases equals how much you have available for sale. And what you have available for sale equals your ending inventory plus cost of goods sold. Now, another way of looking at that is like this right here, right? So let's look at our inventory count. Okay, that right there and this right here. So before anything started, accounts receivable, I have a debit and I have a credit. We're going to do a T account on this. Okay, we're going to do a little there and we're going to do a little here, and this will become somewhat understandable as we work it out. So beginning, oops, sorry, I wanted to do this right here. Where's my left border? There we go. And since AR is a normal debit balance, we're going to have the balance show up on the debit side. So we're going to have all of our debits minus all of our credits. Okay, so now we've got, oops, what did I do? Hopefully I got that right. Yep, I got it right. Okay. So now our beginning balance, right? And this will be our ending balance for a particular period balance. All right, so our beginning balance is 0, right? Our ending balance is 0. Now, if I buy something, a purchase, right? I added, what was that? This purchase right here of inventory, $100. So now beginning balance plus purchases equals what I have available for sale. I haven't sold anything in yet, so my ending balance is 100. But when I sell something down here, right, cost of goods sold, I'm going to sell 10 units, right? So my beginning balance is 0 plus 100 minus 10 equals 90. Now, if you write this out, there's a couple of ways of doing this, right? Ending balance equals beginning plus purchases minus sales. Okay, that's your basic formula. Another way of doing this is what they did, which was beginning plus purchases equals available for sale, which equals your sales plus ending balance. Okay, so they'll trick you sometimes. They'll give you a couple of these pieces of information. They're going to ask what's available for sale. Well, you got to kind of like figure out what pieces of information you have and then solve for the variable. This formula always confuses folks, so I like to use this one. And then you just kind of have to figure out, well, what do I have? So let's say they say you got 90 as an ending balance, you had 0 as a beginning balance. What's your you have purchases of 100. How much did you sell? Okay, so you know you have 90 equals 0 plus what was it, 100 minus the sales is the question mark, X, right? Or for those who don't like X's, we'll just put question marks. Okay, so now you just have to figure out what to do, right? So 90 equals 100 minus what? Okay, and if you do some funky math and move things around, you can actually say a question mark equals 100 minus 90, right? Just swap them around. So the question mark equals 10. Okay, that's one way of doing it. Of course, if you weren't as clever, sometimes as me, let's start with this one. Actually, let's start with this one again. Some people might just go, okay, well, then I'll move the 100 over. So now I have 90 minus 100 equals a negative question mark. So then minus 10 equals a minus question mark. And then you go, well, is my answer minus 10? Well, of course not. It's not minus 10. It is. Those are math wizards. You know this. You're going to have to subtract and times both sides by -1. So you end up 10 equals question mark. Okay, same way of getting to it, but just slightly different. For those who need a little help on that. Anyway, so we'll take that away. We'll just focus on this. So this is how you figure out the missing variable, right? So this formula, to me, is probably one of the easier ones to figure out. But you could also do, beginning balance, beginning, right, plus purchases. We'll simplify this other one, minus sales equals ending. Okay, another way of looking at it. So there's lots of different ways of looking at this formula, but you need to make sure you understand the basis of it, okay? Because they're going to test you on this component over and over and over, okay? So you need to understand how inventory is built up and then reduced. Okay, now they're going to talk to you about a perpetual inventory system versus a periodic inventory system. What I basically simplified mine as was just a perpetual system. It comes on, it goes out. But most systems, well, actually most systems aren't a perpetual, but they're going to usually use a periodic system where they build up inventory, and then when they evaluate the amount of inventory, let's go over here. When they evaluate the amount of inventory, they're going to look at it usually on a monthly basis, because instead of this $1, it might be something different, right? So let's say I made another purchase, same quantity, let's say, but there was a price increase, a 10% price increase. Now I was paying $110. Well, this was for 100 units, right? And this was for 100 units. So my cost per unit on this one equals that divided by this. That was $1, and this is $1.10. Now my average cost at this point, right, equals sum of all, let's make it easy, equals or plus that plus this, right? So I'm going to take, and then what am I going to do to make this a little easier to follow? We're just going to sum these two together. But anyway, so equals the sum of these two together divided by this. So my average cost should be $1.05, right? So the question is, well, what do I use when I do my allocation to cost of goods sold? Do I use the $1? Do I use the 110, or do I use the 105? And this is where it all depends on whether or not you do a first in, first out type of a deal, or a last in, first out type of a deal, or you do an average type of a deal. And there's one other, which is called specific identification. And it all is a matter of when you're looking at this. So this first in, first out could be daily first in, first out. It could be monthly first in, first out. It could be quarterly first in, first out. Same with LIFO and average. So that gets a little bit more complicated. That's what chapter, I think, 5 goes through in quite a bit of detail. Sorry about that one. Wanted to go here. If I can get there. Oh my goodness. Okay. So, but you want to understand that periodic is for a period of time. Okay. And perpetual is continuous. Each time it does the evaluation of the cost of goods based on FIFO, LIFO, or average, or specific identification. Okay. I think at this point, they just want you to understand the basics, and that's it. Okay. So make sure you go through an example like this. Okay. Walk through the whole deal. Understand it. Okay. Because this is going to be very, very important to understand. So far, most of what you've done in this class have been fundamentals. Debits, credits, journal entries, income statement, balance sheet, cash flow statement, right? Principles of accounting, matching principles, stuff like that. Now you're getting, into the nitty-gritty of actually doing the accounting for particular cycles of business. And it can get complicated. And you need to spend time walking through these scenarios. Otherwise, you will get lost very quick. Small little warning. Okay. All right. Now, remember when I talked about, buying it for cash versus buying it on accounts receivable or on credit? This now is going to walk you through these purchases are going to walk you through discounts on the purchases. Now, purchases without discounts, you saw the journal entry. I did this pretty straightforward, right? You buy it for cash. Now, if you do have a cash discount, there's usually, some credit terms. And those credit terms, in the most simple ways, usually are going to be expressed like this: 2% if paid within 10 days. Otherwise, the net amount as due within 60. Okay, that's what this all says right here. Now, sometimes it just says net 30, meaning that you have to pay within 30 days. Right here, this says right here, like net 60 days. I guess they're using 60 days nowadays. In the past, we always had 30-day terms. Maybe people are getting a little loose on credit. I don't know. All right. So usually you have this quoted or defined in little abbreviations like this. So you'll need to understand the abbreviations. And so you'll see the invoice date, the discount period is this, 2% 10. That's the period, this discount period. The rest is when it's due. Okay, everything else is when it's due. So you can pay on the 11th day and not get 2%, but you're still within the 60 days. So nobody does it. They either pay within 10 or they pay on the 60th, one of the two, or at least near one of the two. All right, so that's your terms. You'll need to make sure you understand this principle. Invoices usually have the terms set out on them, like right here. Here's your terms right here. 2% if paid within 10 days. Otherwise, the net amount is due in 30 days. Okay, and that net amount is the $500. Sometimes they have the discount identified. So, if they paid within the 10 days, they'd get a 2% discount. So 2 times 500 is $10. So the net amount that they would have to pay is $490. Okay. So they go through what's due. Okay. And then they show the discount amount. Now, purchases on credit. Oh, we went through the cash. Okay. That's straightforward. So cash and credit are basically the same in terms of the original entry. The question is, what happens when you pay it within the discount period? So if we go back to here, right? I haven't paid my payables yet. But let's say, okay, one scenario I pay, this is let's do this. Purchases are good on sale. Let's do the same thing, 2%, 10 net. Well, I usually write it out, but net, let's call it net 30. Okay. All right. So let's say this, we'll put a date on here now. We'll move this all over. But since we don't need that, put the date here. So let's say this is June 1st. All right. And this is, let's say June 2nd. And this is June 2nd. And then my customer paid on the same day because, well, what did I do? Customer pays in full. Oh, no, they didn't pay. Let's say they paid in 10 days. So let's make this 7 days. Let's say that they paid us on 6/9. Okay, well, I still have one more day. Now that I have the cash in hand, I can go and pay for that accounts payable on 6/10. Okay, I'm going to pay off that this amount within the 10 days. So first of all, I need to clear out my accounts payable. Okay, that for the full amount. So I owe $100. No problem, $100. I'm going to take a discount on the purchase. Oh my goodness, purchases, and that's going to be that 2. So we're going to take 100 times 0.02, 2%. Okay, and my net amount is going to be the cash. So the easiest way to do that is the total amount minus the discount. And so this is paid AP within discount period. Okay. So that's how we'd record that. Now let's just double check to make sure I didn't mislead you anywhere. Right. Now they took the discount to merchandise inventory. So there really isn't a discount on an account. All right, so we have to go back. This was just more for, describing the process. This is going to go to merchandise inventory. So arguably now, well, let's call it inventory since we did the same on the other one. Okay, so arguably now I have another transaction. Let's take this one out. Go back here. So then I have the discount that shows up here. and that's going to reduce the amount. So in reality, now instead of it being an average, a cost of $1, theoretically, it's costing 0.98. Okay, you have $1 minus the 0.98. So $1 minus 2 cents, because $2 divided by 100, 2 cents. Okay, so I might have to go back and adjust this because I didn't transfer 10 units at $1. I transferred 10 units at $1.98. Right, so this is be $9.80. Let's do the math on that. 10 times 0.98, and this would be the same. Okay, so this is how this might have adjusted because I took the cash discount, which is why this transaction might, actually happen on a monthly basis instead of a daily basis. But in any case, I just made the revision. Now, going back here, right? So you have your accounts payable, you have merchandise inventory, and you have your cash. Voila. These are the entries, all your T accounts for what you just did. Now, if I just did it after the discount period, I wouldn't do this. I would have done what I did before, which is just clear out the accounts payable, credit to account payable, and a debit. Oh, excuse me, a debit to accounts payable and a credit to cash, because I'm reducing cash and reducing the payable as it shows here. Now, returns and allowances are very similar to discounts, except, instead of paying for something, you're returning something. And so you have to move some of that back. Now, that's pretty straightforward because it's just essentially the opposite of the payment, right? So let's say on 6/11, I noticed that there was a bunch of stuff that was defective. I should have figured it out up front. In fact, let's assume that I did that. It's going to change all my numbers, but that's okay. Not really all of them, just some of them. Let's say on 6/2, I actually identified that there were some damaged goods. Let's see, returned. Let's do this, returned. Make this so you can see it. Returned, damaged goods. Okay. So the return then is going to reduce inventory and is going to reduce your accounts payable. So we start with accounts payable since that's going to be a debit. Let's say returned, make this simple, 9 units of damaged goods. Okay, one of these days I'll get my spaces and everything right in the right place. Okay, so I'm going to return 9 units. That was equal 9 times the original $1, and I'm going to reduce inventory, right? This is the same as that number. Now what we'd have, move everything down a little bit. All right, we're going to copy these down a little bit. This is the return. So that's the 9. So we're going to have to recalculate everything a little bit, because when we paid for it, we didn't pay for the whole 100. We paid for the 100 minus the 9, right? So this is going to be 91. Do the math on that, equals 100 originally bought minus the 9 returned. So 91. So I took my discount of 2%. I'm only taking 182, right? So we can actually marry this up over here. So now my average cost is much less. Let's just go ahead and figure that out right now. Okay, so my average cost on this right now, let's take this out and let's put the cell. Let's make this a little easier. I know it's getting a little complicated. So let's say we sold this after we made the purchase. We move this down right here. We'll move this up a little bit. Okay, so we put this a little bit in an order that now will kind of make things a little easier. Inventory. I'm not sure if I'm making it easier or not. I'm not making it easier, so we'll just reconstruct the cell, the cost of goods part. Okay. So now let's just say we're doing this on an average cost. So my actual cost now is this purchase minus the return minus this discount, right? That's my cost. And my average cost is going to be this amount equals the 89.18 divided by my total units minus the ones that I returned. Okay, so that's my average cost. Okay, it's still 0.98, probably rounded somewhere. So now when I want to do my inventory, I got to do the 10 times, and we'll just use this number because it might be slightly different. And it's not. Okay, that's good. So this is the cost of goods for that, which makes sense because all we did is took the discount on the 91 and not on the full amount. Okay, so this is now my transactions with the return, with the discount. Made it a little bit more complicated, but that's just the life of an accountant. Okay, so this walks you through not only the purchase allowances for defective goods, but how you do your returns on your purchases. Okay, and now you got transportation costs. Now this is a doozy. Another big component of inventory is shipping, and you have to know who's responsible for the shipping. Most people put shipping on the buyer, which would be FOB shipping point. See, buyer accepts ownership when the goods depart the seller's place of business. Therefore, the buyer pays the shipping costs and has the risk of loss in transit. This is super important to understand. If it's FOB destination, it would be similar to, let's say, Amazon or some other reseller sending you goods. If you never receive it, you don't owe the seller anything, right? So the ownership only transfers when the buyer receives the goods, not when it ships. And so usually in that case, the seller pays the shipping costs and they are at risk of loss. So this little table right here is very important to understand because it determines when you record the shipping cost. Okay. Sometimes, even though the seller, takes responsibility for the shipping cost, they may include it in the invoice. Right. So if it's at destination, then buyer pays for the goods plus shipping, but they only record it when they receive it. No, they record it, until they receive it. If it's FOB shipping point, then they record it the moment it leaves the dock. That's because they own it. It's their risk. All right. They're paying for the shipping costs and everything. So this will determine when the inventory is recorded, when the shipping costs are recorded, who records shipping costs. And so you'll definitely want to make sure you capture this. Okay. Pardon me. It's been a long day. All right, so you'll definitely want to walk through, okay, these different components. Purchase the goods, you paid $30 for shipping, you returned 50, you paid the amount, and you assume the October 11 payment was never made, right? So these are the journal entries and when they happened. You notice this is FOB shipping point. The invoice is dated October 1st. Shipping point, so it's the buyer's responsibility once it is shipped. You'll find one of these that goes through this and says ship FOB destination, shipped on the 1st, but didn't, let's say it didn't arrive until the 10th. And so you wouldn't actually record this entry until the 10th. All right. Hopefully that gives you a little bit more to go with on that. The sales follow a similar dynamic as purchases. So don't get too, once you get one concept identified, like, you know, net 62%, 10, net 60, it follows the same type of approach, whether it's a purchase or a sale. Okay, so there'll be similar journal entries, but different accounts, right? So if we go back to here, purchases go against inventory and accounts payable, whereas sales go against usually accounts receivable and a revenue account. Unlike inventory, when you do the discount to inventory, a discount on a credit sale is going to go into its own little bucket called discounts on sales, something like that. Let me just go over here, it'll show you. Okay, you have your sales on credit, sales with the cash discounts, right? Cost of goods sold, sales on credit. Where's my discount? Within the discount period. There we go, sales discounts. You'll see these are an income statement account. They're a contra revenue account. They reduce revenues, and so you get to net revenues. And so this is what you'll see in terms of the payment side of a accounts receivable. Returns and allowances are the same, but just different accounts. Okay, so these you'll be able to follow fairly straightforward, and definitely make sure you walk through this type of solution. Okay. Of course, you have varying adjustments to make. Those could be for what they call shrinkage. Shrinkage, the loss of inventory. There's lots of reasons why inventory could be shrunk. It could be stolen, it could be damaged, it could be lost. There's lots of different reasons. And so usually there's an inventory that is done on a regular basis to determine actual amount on hand versus what's in the records. And then there'll be an adjustment, an increase or a decrease, usually a decrease. And so that decrease will decrease accounts receivable, decrease inventory, and it'll increase the cost of goods sold. So this is a balance sheet account, and this is an income statement account, right? So it's an expense that's being recorded due to the shrinkage. Okay, here's your typical entries to close out all your accounts. Very straightforward. And this is a nice little cheat sheet, if you will, of the accounts that are used on the purchasing side and their debits and credits, types of transactions, and the sales side, accounts, debits and credits. Okay, so if you need a quick little way of looking at this, this will be it. Any of your adjusting entries, your shrinkage accounts, your sales discounts, your returns and allowances, all those are in here, and then any of the closing accounts. Pretty nice summary right here, and a quick review of how to record shrinkages. This is a little bit more detail on an income statement, multi-step. It kind of takes your sales, minus your discounts and returns, you get to a net sales amount minus your cost of goods sold equals your gross profit. And then you'll have your selling expenses, your general and administrative expenses detailed and then summarized. And then so your gross profit minus your total operating expenses is going to equal your net income from operations. And then you have your other revenues and expenses listed here, usually interest, some extraordinary gains on the sale of an asset, and interest expenses. And so you have a net amount here. So the 12.9 minus the 2 or plus the 2 because you had a gain on the sale effectively gives you a almost $15,000 net income. That is a multi-step income statement, all right? Think of this as a detailed approach to come up with the income statement. Whereas your single step is just going to summarize it all, right? Net sales, you don't get your gross minus your sales and allowances or your returns. You might have your interest revenue, your gain on the sale, all your income on the top, all your expenses on the bottom to come up with a net income, okay? 2 basic ways of doing your income statement. Most people, by the way, most companies will do it this way. Unless they're trying to hide something, and they'll do it like this. It really isn't hiding it in some cases, but you don't get to see their total sales and all the returns and allowances that they end up doing. Balance sheet, classified, pretty straightforward. Won't go into this in more detail. All right. And lastly, your ratios. This one's probably the hardest one, this asset test ratio, because it's not obvious what you need to do. But it's really, if you had to liquidate stuff right now, if you had to pay stuff quickly right now, what could you use to pay off your current liabilities? And your current liabilities are usually your accounts payable, right? Or your salaries payable, those things that are due within 30 days. And so you're looking at cash and cash equivalents plus your short-term investments. Those would be things like certificates of deposit or bonds or something that you can sell in the market immediately, like today, get the cash to pay any of your currently due liabilities. So receivables is also in that form because usually receivables are payable within 30 days, maximum 60 days. So that's a pretty good number. So you got cash, short-term investments, plus your current receivables. That's what you can rely on in the near term to pay all your current liabilities. And so your ratio, the bigger your ratio, obviously the better. The smaller your ratio or a negative ratio, not so good. Or negative meaning something less than 1 is not so good. All right, so this is how they calculate it. Gross margin, pretty easy. It's really just your net sales minus your cost of goods. So your gross profit divided by net sales gives you your margin ratio, which is really a percentage, right? 44.6%. Okay, so that is pretty much it for chapter 4. Hopefully this gives you enough detail, enough explanation to help you walk through it. You still will have to do the hard work of working through some of these examples and committing it to muscle memory or to knowledge, not just understanding. So let me know if you have any questions. I hope this helps out. And I look forward to seeing some great work this week. Take care. Bye.